Over 1,500 people lost their lives when the Titanic sank, and it triggered one of the biggest insurance payouts in history. The Titanic's maiden voyage is a story of tragedy, but it's also a story of trust, resilience, and financial innovation. Lessons that still shape the way our financial protection systems work today. In 1912, the RMS Titanic wasn't just the largest ship ever built. It was a floating symbol of human ambition and engineering confidence. But behind all the glamour and the hype sat a quiet, practical question. What happens if the unthinkable happens? And so the ship was insured with Lloyd's of London for £1 million. That's the equivalent of several billion pounds today. The policy was arranged through Lloyd's of London. Back then in 1912 and still today, Lloyd's of London are the beating heart of global insurance. But here's what's truly remarkable. There was no single insurer behind the Titanic's policies. Instead, the policy was syndicated across dozens of insurance underwriters, each one taking only a small fraction of the risk. This approach to insurance is known as risk aggregation, and it was designed so that no single insurer could be sunk by a single claim. On the Titanic's policy at Lloyd's, the largest single share was £75,000, a huge amount of money at the time, and this was taken by the Liverpool, London and Globe Insurance Company, with the rest of the risks split between many other names, all recorded by hand in the famous Lloyd's slip system, still used today. And when the news broke that the Titanic had struck an iceberg and gone down, Lloyd's kicked into overdrive. The underwriters, the brokers, the clerks, many of whom had insured and underwritten ships their whole careers, knew that this one claim was going to test everything the market stood for. Yet still, within 30 days, the claim was settled and paid out in full. £1 million honoured, with no argument and no delay. The speed of the payout was almost unheard of. But that was a deliberate move by Lloyd's. Lloyd's knew at the time that trust was the most valuable currency, and making that £1 million payment quickly proved the system worked. And quite remarkably, none of the insurers behind it went bankrupt. The financial world had just witnessed one of the largest coordinated payouts in history, and it was absorbed entirely through shared or aggregated risk. And this one event became the blueprint for something even bigger. Reinsurance. Insurance for insurers. After the dust settled and the Titanic claim was settled, insurers started asking one key question. What if we could apply the same pooling idea and aggregate risk on a global scale? And that's how reinsurance networks began to expand across Europe and North America, so that when disasters did strike, the cost was distributed across many markets and even continents. It meant that a storm in London, a fire in Liverpool, or a passenger liner sinking in the Atlantic could be absorbed by the market without it collapsing any one company or even an economy. And it literally only took until the 1920s for this concept to evolve into a sophisticated reinsurance market that we still pretty much have today. And it's the quiet backbone of financial stability across the world. And it all traces back to an overconfident captain, an iceberg, and 1,500 lives lost in the Atlantic. So fast forward to now, and risk aggregation is absolutely everywhere. It's not just in shipping or insurance, but it's in banking, investment, and even mortgage lending. Mortgage lenders aggregate risk across thousands of borrowers. Insurers aggregate risk across millions of policyholders. And reinsurers aggregate that risk again at global levels. The logic's really simple. Share the burden, spread the cost, survive the shock. And that's the quiet brilliance of insurance. It's a collective safety net. Whether it's life cover, critical illness, or income protection, we're all contributing small amounts so that when disaster strikes, the system can stand strong. The Titanic sinking may have been one of humanity's darkest hours, but financially it was proof that even a catastrophe can be absorbed through cooperation, planning, and integrity. It wasn't luck that saved the insurers behind the Titanic, it was structure. It was diversification, trust, and shared responsibility. Exactly the same values that still underpin the financial world today. So next time you're thinking about insurance and you're thinking about small print and paperwork, remember this. In 1912, it kept the financial world afloat when the largest ship in history sank to the bottom. Tragedy, trust, and triumph. The Titanic proved that even in disaster, systems built on trust can endure. Follow me for more stories from the history of money, where finance meets humanity, and where lessons from the past still protect our futures today. See you next time.